everyone. Glad to be here. The ReSource Pro Summit. Hopefully you guys are having a great morning. So my topic today is benchmarking analytics in employer health benefits. And I like to start with a story. Several years ago, I was actually, my company had just won a client recently, and I was the first time meeting with the client and the CFO. And the CFO came up to me, presented this benchmark report that he had. And knowing I'm an actuary, he showed himself, and he was 22% above the benchmark PPM, medical healthcare cost. And he looked at it and he goes, fix it, And I was like, okay, let me dig into this number a little more. So we took it back and we kind of started doing the analysis that CFO had provided. And he was a sharp guy. It was a manufacturing company, 3,000 lives, and their benchmark was 22%. Healthcare medical benchmark was 22% of the benchmark he was showing me. So I looked at it, went in, and then what I did was, like an actuary does, we kind of risk adjusted the number, right? So we looked at their geography, where they're located, right? We looked at their plan design. We looked at their healthcare morbidity, like risk score. We looked at their clinical chronic conditions. Once we normalized for everything, we realized they were actually performing 4% better than the benchmark. So this is really to emphasize how important it is to be comparing, like apples to apple, benchmark, and why it's so important. So he was about to cut benefits of 3,000 employees because of a faulty comparison. So why I would like to start with that story. This is a true story. So this is why I like to start with this, at least on this topic here, why it's so important to benchmark appropriately, like your health benefit. And then keep in mind, like when you look at, employee benefits, healthcare makes up about 65 to 70% of the total cost, right? 10% of your total wages. So it is obviously a substantial amount that you have to kind of like consider when you're actually looking at your budgets. So my name is Nauman Shaikh. I'll start with a quick introduction. I am a designated professional actuary, have been for 24 years now. I've worked in consulting. I've worked on the carrier side, kind of done, everything from risk modeling, plan adjustments, to reserving and, obviously rates contribution, setting all those strategies for many of, across the table from CFOs and CHROs. So I've done that for many years now. And this is a very passionate topic for me just because I feel like having adequate benchmarking is the key, especially the environment we're in right now. So to me, that is definitely a very timely presentation. So why, what, and how to benchmark effectively? So to me, those are the real three big questions you should be thinking about, and every employer should be thinking about when you are looking at your metrics and numbers and how do you compare it. So why now? The stakes are higher than ever before. Now, if I told you healthcare trend was 2% every year, very predictable, you might be like, okay, you know what? We can kind of predict where we're going. We can budget accordingly, right? But healthcare, as you guys all know, is trending more rapidly than any of the other benefit lines, right? Specifically pharmacy, but even medical, you see a lot more trend. It's a hot topic for most people right now. And healthcare is the top three operating expense. It is top three, but for most employers in the US, it's the second biggest after wages. When it comes to operational expense, second highest for most employers in the US. But unlike wages, healthcare is much harder to predict, right? Wages, you have a good kind of handle on, but when it comes to healthcare, most people have no idea what they need to budget the next year, and is it going to be adequate or not, the cost volatility, compounding, annually, especially with the pharmacy, push that we've had in the last several years. And then CFOs, they demand, they really demand predictability to know what they're budgeting. They don't like surprises. stop loss and specialty exposure, and I'll get into a lot of the details, but this is why I'm saying why now it's kind of so critical is just where we are in the environment and how healthcare has taken over the budget. I mean, it's making about close to 20% of US budget now, so just healthcare. So it's definitely a big speed, and it's not even just commercial population, Medicare, Medicaid, doesn't matter. It's all, the pressures are there all across. So the big question right now is what to measure. Right? You want to benchmark something that actually means something. So like my example, and I'm going to refer to that beginning example throughout, just to kind of, really hold on why that it matters so much. Real key things I'll talk about: risk-adjusted cost versus true peer cohorts, unit cost, utilization, and mix shift. If you don't know what those three things mean, those are critical, and I'll elaborate on those more. High-cost claimant, tail risk. There's a 550 rule now and a 2080 rule. Basically, 5% of your members make up 50% of the plan cost, and 20% make up 80%. So that's the tail risk. How to benchmark and prepare accordingly to kind of evaluate that tail risk. And then clinical quality, future cost trajectory, we'll go into that. So that's what to measure, and then how to act. I mean, the key here on how to act is really how do you change this insight. It's great to know that you're doing good, or you're above or below a 3%, a benchmark. But what do you do with it? How do you act? And I think this sometimes gets forgotten. A lot of times when I'm sitting with employers, it's like, okay, what are the next steps? We've got to given the observations. Let's figure out how do we mitigate that kind of risk. And the key here is that you do want to separate inherited risk from controllable risk. What you can control and what you've inherited. If I'm a new, and I'll probably go into that in a little bit more detail, but like when I talk about inherited risk, if you're a new benefit consultant on a client, you cannot change the demographics. And for the most part, if you're there, the plan designs are what they are. Yeah, you can tweak them, but the demographics are really what you've just inherited, right? You can't really change that overnight. So it's really what you can control and you can't control, and we'll go into that in more detail. But really going back to the why. Rising healthcare costs. What is really driving the market? Just so you understand, like what is really driving, what is behind the force we've been talking about for, I guess I feel like ever since I've been an actuary, this has been an issue where healthcare costs has been rising more than like general inflation. I mean, aside from that one COVID period where the cost came down just because the utilizations were dropped, but really it's always been trending higher than just general inflation. So right now, 2026, we're looking at 9 to 10% healthcare trends. This is actually 2 times higher than even just historical levels. Now, we were seeing about 5-6%. If you look at any of the underwriting, you'd see most people or actuaries are using 6 to 7% for medical. Now you're seeing 9 to 10%. What's really striking to me is that last several years, even the actuaries underestimated the healthcare trends. Most brokers and consultants did. They underestimated the actual impact, and it came out after the year ended. They looked at a recast in a study, and they realized, okay, they were kind of like understating the trends. And part of this is why a lot of employers were under budgeted, just based on the fact that some of the key assumptions around healthcare trends were kind of understating. And the big issue here, really alarming, is most employers budget about 4% for healthcare increase year over year, while I just mentioned the trend is 9 to 10%. Now that's an extremely dangerous gap that must be closed. So you have to either absorb that difference or be strategic and make changes to mitigate and come to a 4%. You have to do one or the other. And oftentimes they end up absorbing it if they're not strategic in how they plan ahead. The 5 big things I would say that are causing this 9 to 10% trend, and you guys might have heard all this because everyone talks about pharmacy right now with GLP-1, gene therapy, cell therapy, drugs. So that is definitely now specialty drugs now make up 50% of the total pharmacy spend. So that's definitely one of the big drivers in what we're seeing in healthcare. Chronic conditions, post-pandemic. There's been a rise in chronic conditions, obesity, hypertension, behavioral health, cancer, so many much more chronic conditions that are actually now brewing since the pandemic. So delayed care rebound, this is one that was the pent-up demand as of COVID. Now that's pretty much baked in. But initially during COVID, a lot of people were, any type of like surgeries that were not necessarily needed immediate, a lot of delayed happened. And that's why utilization dropped substantially in COVID. So now you see that's kind of picked back up. The utilization has actually picked back up now that we saw a drop during COVID. Provider consolidation, that's a big one as well. I mean, we see a lot of reduced competition due to a lot of hospital systems consolidating, M&A activity, and that is, kind of like really a lot of employers and health plans have less leverage when it comes to it. Market by market can vary, but definitely there's been a lot of pressure there. And then medical inflation. I mean, we just know that cost of most things have just gone up and it's been escalating. So the three big things I would say. So I talked about the pent-up demand. That's pretty much kind of resolved. But you really have to ask yourself, are these things more structural or cyclical, in nature? So aside from that pent-up demand that I talked about that was COVID-related, that was kind of cyclical, all the other things I mentioned, high-cost claimants, specialty drugs, chronic conditions, and medical inflation and provider consolidation are a structural change, not necessarily, meaning they're here to stay. So how do you plan ahead? How do you plan accordingly, given that these are now structural changes? And you talk about high-cost claimant. I talked about the 550 rule. I remember when I was a new actuary, this is like 20 plus years ago. I remember like one of my fellow actuaries, we used to get claim files from clients on CDs back then. And I remember like he had popped one in and he was like looking through their claims and we saw $1 million claim. This is back in the early 2000s. And literally all us actuaries that gathered around his cubicle would be like, wow, that is crazy, $1 million claim. And now you come back, fast forward 25 years, I mean, $1 million claims have not only been growing, I mean, in frequency, but also severity. It's like it's almost become the norm to see those in a claim report, $1 million+ claims. So that's definitely taken control. I mean, you have gene and cell therapy treatments, per patient treatments that are over $2 million just for a treatment. And, like I mentioned about specialty drugs. And even with pharmacy, it's interesting. Like, when I first started, pharmacy had made about 20% of the total health cost, 20 to 25 if there was like a lot more utilization of pharmacy. Now you're seeing 35%. I mean, pharmacy has been trending, at a much higher rate than even medical inflation. So you're seeing that become the big part of the overall cost. So you've seen that dramatically increase. Chronic conditions, like I said, post-pandemic, there's been a huge acceleration in chronic conditions. So when you talk about diabetes, hypertension, obesity, behavioral health, all those have been rising post-pandemic. So this is something, obviously, number two, I would say those are like big one. But the number three one is really interesting because to me, that's one of the levers that most people aren't like taking advantage or looking into as much is the medical inflation and provider consolidation, right? And to me, unit cost, which I'll go into more detail, is the key. It's like a trigger that you can easily change. And you guys all probably familiar with discount analysis, looking at what your carrier is providing in terms of discounts. And I mean, I know Pete, you're going to be talking about transparency data, is how do you actually leverage that to figure out what you're actually paying and who's actually providing the best or steepest, discount best network. So network access has become a huge issue, is how do you actually capitalize on that transparency data that CMS released, right? To me, that's a big one that one should be looking into. The one thing I would say is the problem might not be your costs, but how you measure them, number one. So this goes back to my earlier case study or example of the CFO, freaking out because his, benchmark was showing he was 22% more than, the sort of the overall national average. Is, benchmarking, if your benchmark says you're 3% below average, does that mean you're performing good? You're performing well? Or does it mean you're just underinvesting in your people? I mean, that's the question. And so then the three things I would say that are the key, I would say, on the right. First of all, benchmarking without risk adjustment does not tell you anything, right? You really need to be able to compare a risk-adjusted PPM. So when you're looking at the total cost, like that CFO did with me, he just looked at his total budget divided by the employees. He's like, hey, this is my per capita cost, and this is what I'm reading on the news, what the trend is, and I'm 22% higher. But I'm like, okay. If you look at a manufacturing company that has an average population age of 52, compared to some high-tech company, average age of 34, yes, there's going to be a huge compare. That difference alone could be 15 to 20% in your PPM. If you're working alongside retirement actuaries, every year, the average for employer group, every year can add anywhere between 1.5% to 2.5% more cost in healthcare every year, every age. So if you're looking at a group that's in their 30s to early 50s, that alone could explain about 15 to 20% of that cost. The other thing I would say is the averages hide the real story. When you look at a total PPM, yeah, you could be doing better, 3% better than the average, but it doesn't tell you what's actually underneath that PPM, that overall aggregate dollar. You really have to look at your unit cost and utilization, right? So your utilization could be 10% better, as in less utilized, but your unit cost could be 6% higher than the average. So it kind of masks, when you look at the overall aggregate numbers, it kind of masks the underlying factors, mix shift, unit cost, utilization. So what you want to do is really decompose that PPM and benchmark the factors that lead up to that aggregate number. And then number 3, I would say, benchmarking your cost without predicting it is just an expensive report, in my opinion. You really need to be able to use that to predict the future. What does that mean? How does that benchmark telling you something about the future? So to me, those 3 are sort of the main things to look at, and I'll kind of talk through. This is sort of the framework that I'll talk about that kind of addresses those 3 I would say issues that I see common, right? Not adjusting your risk, your overall PPM, your overall score is your number 1 risk. Number 2 is only looking at aggregate PPM, and not looking at the decomposing it to look at what's triggering that PPM aggregate dollar, and then not being able to predict it. To me, those 3 are issues that I see over and over that people are doing when they're looking at benchmarking report. This is kind of a framework kind of addresses and solves those 3 issues. Number 1, if you have the data, number 1 thing you want to do is be able to look at the demographics and adjust for the demographics. Age, sex, look at industry, look at salary bands, geography. You want to be able to look at family status, health morbidity. You want to be able to normalize your demographic to the benchmark you're looking at, number 1. Number 2, plan design. Obviously, if you have a richer plan, it's going to be higher cost. So you want to be able to adjust for plan designs when you're comparing 2 numbers. Deductibles, out-of-pocket, copay, coinsurance. You want to look at actuarial values. How do they relative values between plans, and be able to normalize for those 2. So those number 1 and number 2 kind of adjust for my risk factor number 1, right? Like you look at the PPM, an unadjusted one, that does not compare apples to apple. So you want to do risk adjustment. So that's 1 and 2. Number 3 is healthcare costs. Overall, your PPM. This is what I was talking about. Is great. Now you have a risk-adjusted PPM. You're comparing apples to apple, but you're looking at an aggregated number that's not telling you sort of the decomposition of that number. So you want to look at unit cost, utilization, and even mix shift. So what do I mean by that exactly? So when I say unit cost, that's the cost of an MRI, So every time you go for an MRI, what is the cost? That's the unit cost. Now, utilization is how many times did you have the MRI, right? That's the frequency, how many times you have it. And the mix shift is more like the distribution of claims that change in your population. So for example, a perfect example is pharmacy, right? Like I mentioned, pharmacy has taken up, the mix has changed, where pharmacy now accounts for 30 to 35% of total cost. It used to be 20%. Your mix is shifting. So if you only look at the PPM aggregate number, you miss those details, the unit cost, utilization, and the mix. The mix of claims. So this one addresses the number 2 I mentioned, right? Only looking at aggregate and not actually looking at building up. And the last one is clinical. Clinical is, quality care management. Obviously, most people are probably used to looking at clinical reports where it kind of shows you inpatient admissions per 1,000, ER utilization, right? Those are like clinical measures deep in your data. And to me, that is the key when looking at gaps in care, drug compliance rates, chronic condition prevalence. And those are what are the leading indicators for tomorrow's cost. So you need to be benchmarking. So my last part of the 3 was not being able to predict, because benchmarking really looks like a historical. Looks at, okay, how you did last year. No guarantee that benchmark's even, good for the next 24 months. The client could be very different. So why you need to look at clinical measures is that is sort of the leading indicator of what your future large claims, chronic conditions are telling you. So to be able to look at that is the key. So those 4 things I would say are extremely important when it comes to solving those 3 issues I talked about. So, this kind of like really explains more in detail about what benchmarking should actually measure. I already kind of mentioned about risk normalized total cost, right? Number 1, the key is like adjusting it properly. And that was like I mentioned about demographic plan designs that you need to be adjusting to normalize. Number 2 is the cost decomposition analytics, right? Again, this is the unit cost utilization and the mix shift. You want to make sure that you're looking at not just the overall cost, but looking at, okay, you might be doing great on unit cost, but not on utilization, or you see the mix shift favorable or unfavorable. You really want to look at deep down into what's actually driving that your cost. And then the high cost claimant analytics, employers consistently underestimate the tail risk. And the tail risk, again, like I mentioned, is that, the 5% that make up 50% of the cost. They continuously underestimate that high claimant cost. And again, this goes back to why we need to do clinical benchmarking at that level, because that allows you to kind of look at what this prediction of these future high-cost claimants might be. And keep in mind, a lot of times you think about high-cost claimants, they're like, oh, you know what, they're kind of unavoidable. Oftentimes, there's just going to happen where people, get a condition, and it's not something that you can prevent. But studies have shown almost 40%, 30 to 40% of high-cost claimants are avoidable, which is a large amount, definitely like around a third to slightly more, are actually avoidable. Anyone who does that and predicts better and puts the right things in place can avoid these huge multi-million-dollar claims. So 2 other things I would say when you are looking at benchmarking. So 2 big things, trend benchmarking and volatility. And what do I mean by this? This comes, the volatility might be a little bit too actuarial, but I'll explain that in layman's term. So really what you want to do is you don't want to look at just 1 year. You want to look at a multi-year approach when you're benchmarking, because 1 year can be a one-off. It could be favorable, unfavorable. It could be a total one-off. What you want to look at is multiple years, 2 to 3 years of how you compare to benchmarks and looking at those metrics. Because if it's continuously you're above benchmark, then it's not a one-time issue. It's a structural issue that you need to address if it's a multi-year issue. Right? So you definitely want to look at that. You definitely want to isolate pharmacy from medical, for example. Look at pharmacy trend on its own. Because oftentimes pharmacy, when you group it with medical, it masks the underlying issues in the pharmacy that we've been seeing, the trend. So you really want to isolate pharmacy, medical, and even look at condition-specific trends like diabetes, oncology, like cancer, like that are like really prevalent right now. You want to look at their trend specifically. What is your trend on any of those specific chronic conditions? And then obviously specialty drug, we kind of talked about that. That is huge, and how you're being exposed to that. Volatility benchmarking is interesting. Like if you look at 1 year and you might be in line with benchmark, that's great. But what we want to look at is your claims, is how volatile they are year over year. So there could be some employers, and you could look at some data sets, and the volatility 1 year to 1 year is substantial. It could be 20% up, 20% below. And even though you might be good 1 year, But if you're not like really, if you have a very volatile kind of experience and claim costs, that's going to make it much harder to budget and predict appropriately. So you want to get a good sense of what the volatility is. So what we typically do is look at actually, like the claim files, and we'll actually run it through like a standard deviation to kind of see, okay, where does that lie? Where does that volatility compare to others? Is my client more volatile than sort of the benchmark? In terms of the fluctuation, what I'm comparing it to peers. So I think this is really important when it comes to measuring like stability and even reserve adequacy. Are you holding enough reserves if you're a self-funded client? Are you holding a reasonable amount of reserves to make sure that going to cover any of that volatility? So that's the two things I would say a little bit more advanced in terms of being able to benchmark is this volatility measurement. So what is this 4-step framework that I want to kind of talk about data analytics? To me, this is one of the keys. Is if you take away, like to me, this is one of the key slides, is like, there's, people talk about healthcare benchmarking and don't really break it down. What do they mean by that, right? Like, what are you exactly benchmarking? So to me, the way I look at data analytics, and Bob, most of you guys are probably familiar with like data warehousing and data analytics. There's so many companies right now that are doing that are looking at data and doing like more of a prescriptive approach. Number one is you want to do a descriptive analysis. That's just your standard benchmark comparison, like PPMs over trend, like trend over time. You're looking at that. You're looking at like your top diagnosis, claim by category. This is pretty common. Most people do one. They're looking at that benchmark, and that is actually just telling you, what is the historical data telling me? Where do I stand? I'm running 3% over my budget. Great. That's a descriptive analysis. Number two is more of a diagnostic analysis. Why am I 3% over my budget? That's the answer. That's the question, is why. This is where you would do what I mentioned about cost decomposition, looking at unit cost utilization, mix shifting, risk-adjusted peer comparison, and site of care analysis, right? Urgent care versus ER, like what is that mix shift? So this is where the 3% over your budget would be explaining the why. The predictive analysis is very interesting, and the problem is most employers stop at 1 and 2. Right? And that's it. But the most crucial ones are 3 and 4. So the predictive analysis is telling you, if you're seeing an increase in specialty drugs, right? You see that in your data. You can see why you're 3% over budget, because your pharmacy spend has gone up. Okay, great. That answered it. But now what, right? Predictive will tell you, are you expecting this trend to continue onwards? It's telling me I'm running over budget by 3%. I know why, because my pharmacy claims are off the charts, and I know that this pattern of pharmacy claims, GLP-1, gene therapy, cell therapy treatments are there to stay, and they're going to be there in the future. So now I know that's going to continue into future. What can I do about it now? That's more the prescriptive analysis, right? So this is now very strategic, right? Either you work with your pharmacy experts to figure out the right plans if pharmacy is the cause, right? If it's cancer claims, you might want to work with some people that specialize in more like a health population management and see what are the right levers you can actually use. But prescriptive analysis is more like, okay, now what do you do? It could be a funding strategy, which is much more of a like a bird's eye view of looking at overall how you're funding your plan. It could be network vendor. Maybe you're just paying more because your carrier partner, the discounts or network access could be an issue, and maybe that's the reason what you need to kind of fix. Could be a benefit redesign, PBM. Maybe you have to really look at that to kind of understand how you're going to fix this in the future. So essentially, or care management program, like I said, maybe like cancer or something, and how do you kind of address it through the right programs in place. So this, I would say, is kind of like that framework that you want to look at. And this framework addresses those 3 risk factors I talked about. Again, now it comes down to how do you change your analytics into real decisions, because in the end, that's really what matters. And really, this leads into 3 big things I'm seeing in the market right now, at least. So these are the 3 I kind of picked up. Number 1 is, how are you funding decisions, right? If your benchmarking is not helping you make these type of decisions, strategic, then the benchmarking, like I said, to me is just an expensive report. It's like funding decisions. How are you funding your, if you are fully insured, sort of arrangements? Is that is there probability there? Is there like, what is the sort of the mitigating scheme there? Like that might potentially save or kind of have you more control. Because if you're fully funded, you're kind of limited to what you can control. A lot of people move self-funded not because they're saving money. Like I get it, premium tax and, and profit margin and, all that, you're saving on some of that. But it's really people move more self-funding is more to have more control. I always say that, like if you're an employer in the US, you are in the business of healthcare, like it or not, So the better you manage your costs, the better, your operational, control will be. So a lot of people, and now we've seen that trend continue more and more of more people moving to self-funding, right? Like I know even like under 200 people, live groups, now over 30% are self-funded. Which I remember when I started, self-funded was considered for the upmarket, larger. Nobody really did that, but this fully insured market is, or self-funded market is growing rapidly. It has been, and that trend's been continuing. So funding decisions is a big one. Vendor and network strategy, right? If you're benchmarking and you see the issues are around unit cost, which is the big lever, and I would say that right now, unit cost is what's driving a lot of the cost. Right? That's why I feel like, being able to leverage even transparency data and understanding what the contracts are, how do you compare, what is the Medicare prices, what are the cash prices, what is the different carriers and their prices for different, inpatient by service category, looking at inpatient, outpatient, professional, looking at what those differences are. It's more important than ever, just because I do think that's where the big pricing pressure is on unit cost. So looking at your vendor and network strategy after benchmarking is the key. And then lastly, I would say pharmacy strategy, right? You want to be able to look at, like I said, that's one of the key drivers. Pharmacy is trending much higher than even medical for several years now. So you want to be able to look at what the specialty penetration looks like, GLP-1 exposure. So all those things, or biosimilar adoption rates, that's a big one to actually look at where there are real levers that you could use. So those are type of examples that I'm seeing over and over where benchmarking reports properly done lead to these type of decisions that your employer would actually, or any plan sponsor would look to make based on those results. But I really did want to talk about the future of healthcare cost benchmarking. What does it look like? What are they doing? What are actuaries and a lot of these data analytics companies looking at now? How are they leveraging AI? Right? How do they plan to do that? The problem with benchmarking, a lot of times when I see clients, they have a carrier and every year, they'll come do an annual review and they'll show them, like a detailed report of how their claims are tracking. They'll look at some clinical and tell them where their pharmacy spend is and all that. It's usually once a year. Some might get it quarterly, but usually it's once a year you sit and talk about what's really driving your healthcare spend. The problem is that healthcare cost is spiraling so fast year over year, you cannot wait another year to look at what's changing. You really need real-time benchmarking. You really need real-time benchmarking. So what's changing in the future? Number one, these are some of the emerging capabilities, right? Real-time dashboards, not looking at quarterly, once a year, but actually doing replacing a static report with like current, cost intelligence. So that's where the future is going right now. So if you do have a data warehousing or data analytics company, most of them are using AI to kind of figure out how they can actually perfect a lot of these capabilities I'm talking about. The other is predictive alerts, right? AI flagged high cost claim trajectories weeks in advance, telling you that, hey, we're seeing this exposure in high cost claimant just based on some of the utilization of their units, and how can AI use to detect early before this becomes a large claim, and it'll flag automatically just based on the claim patterns. Number three is looking at micro cohort analytics. So again, that's more like looking at specific high driver cost driving services. So GLP-1s, rare disease cohorts, or looking at specialty RX, like I said, separately. So these are micro cohorts. You're really tying into some episodic conditions that are going to be potentially big drivers. So that's the analytics you want to do. Number 4, AI anomaly detection. That's surface billing anomalies, fraud, payments or clinical outliers, anything that AI could flag for you, they would do. So you kind of actually have that beforehand. You know that ahead of time. So those are really like the big things I would say is happening in the benchmarking industry. And if you have a data warehousing or analytics company, if you're leveraging it, if you're a broker and you partner with one, or have your own, or if you're an employer, right, and you have a broker, are they actually looking at? You should be asking these questions. How is that changing? How is this evolution of benchmarking going to help me make decisions? We live in a time now where data is gold, right? Data is everything. So anytime I go, it's not just even healthcare. Everything companies are doing now is data driven. So their healthcare cost is no different. Most of these, when I meet with clients, they come and ask me, how are you leveraging our data to make us make more strategic decisions? They want that answer. How are their brokers doing that? How are they helping them make these decisions? So this to me is sort of the key to understand where this future is going. And I really believe whoever's ahead in this curve, can adopt this, and the faster they can adopt to leveraging AI to kind of realize what this future risk is and plan accordingly is really going to make a big, big difference, in my opinion, on how well they manage their health plans. Real big takeaways, demographic plan design benchmarking, I kind of mentioned, it kind of explains what you inherit, the cost. Your population is your population. If you are a manufacturing company, yes, you're going to have definitely more of an aged population with probably a lot more chronic conditions than a young high-tech company in Silicon Valley. So really understanding what is the cost you inherit, right? Separating that from, what you can control, right? So to me, that's one of the keys to keep in mind. Healthcare cost benchmarking, explain performance, your risk-adjusted efficiency relative to your true peers. Really being able to explain the performance based on a normalized scheme. And then clinical benchmarking, predicting sustainability, the future. What are you seeing? Are you benchmarking those metrics that are telling you where that future cost lies? Not looking at backward, but looking at the future. What are those key metrics you need to be benchmarking and validating to see where that future risk lies? Those are what you need to be benchmarking to. So overall, I would say those 3 things as a takeaway. Are you benchmarking those metrics that are telling you the future story, not the past? And I think you guys would all agree, most benchmarks are sometimes they're even outdated, right? You're comparing benchmarks that's a year or 2 years old, and then they're not telling you the full picture. And the real thing is that a lot of these CFOs, CHROs are making decisions based on faulty data. And I've seen it over and over again. They're cutting plan designs where they might actually be, richer for 1,000 people in that one example I gave in the beginning. So that is really what you want to look at. What your member population, your demographics is, over time you can change and, your population evolves. But if you're a new benefit consultant on a client, that's not something you can change immediately, right? You've inherited that. And that is what your starting point is. So really it's more like focusing on what you see in the future and what you can control than looking at what you've just, kind of inherited. If not, this was great. Hopefully this was valuable. Hopefully you can go back and actually look at, speak with your health actuaries and say, hey, how are we benchmarking our clients or our, if you're a health plan, how are we actually doing this? And what is our plan for the future? I really again, I would re-emphasize that, if you take away the future capabilities and how you're looking at predictive benchmarking, is going to be the key. How is AI being leveraged for your population? Because I think that's really where it's going to make the biggest dent in the next years to come. So thank you.